I just wanted to speak to one thing if there's not a question. So there's this overlying comment that you hear out there all the time, like interest rates go up, bad for the markets. And I just want to speak to a period of time that you could all relate to. And this was in 1994. Um, Greenspan rose rates a half a dozen times in 1 year. And so you might expect the next few years would be a really tough time for the markets, right? Interest rates goes up, markets don't do well. Well, what it actually did, if you recall, 94 was not a great year. But what came after he rose rates 6 times in 1 year? 95, 96, 97, 98, and 99, the tech bubble. So raising rates unto itself does not destroy markets. There's no evidence supporting that. I wanted to speak to that because this huge fear of interest rates destroying the stock market is not supported in evidence at all.
Looking forward, this is for the year ending in this quarter. There's a base case that we're expecting 6.6% growth. This is the conference board. This is the survey they do that talks about lots of different economists check in and they give us the idea about what growth is going to be. And so they have a base case of 6.6, and then they say, you know what? Worst case scenario, the vaccine mutates, we have a new wave of shutdown, we have a new wave of virus, we have a new wave of issues of response. Vaccines are ineffective. We have the Fed tightens too soon. We have the improvement in unemployment declines. The consumption that we know we all want to continue, and we know that there's things that we want to buy that we're not buying yet because we can't, things aren't available. I've got a buddy who ordered a pickup. I won't even go into this particular friend, but he ordered a pickup 3 months ago, and it's going to be, it keeps getting pushed out one more month because there's no chips for the pickup he's buying. Or we might see a stock market correction that'll make us all feel less wealthy. We'll spend less. So this is the worst case. On the flip side of that, there's this best case. What if COVID cases continue to fall? What if this most recent Delta variant uptick stimulates those states where you see that uptick to vaccinate more quickly? What if we have less social distancing? What if the infrastructure plan passes? What if the next thing passes? There's all kinds of things that could happen that could increase it above the 6.6. And these are all big things. So if we see 7.4%, and what just remembering that's for the year, we could see up to 9% in the quarter in this, when they report the second quarter on the 29th of July, we could see a 9% number. But even looking back for the year, the 12 months prior, you could see an average of 7.4. And that's a big growth number. And that's not the end of it. Next year, we probably see 3.5 or 4. A year after that, we probably see 2 to 3. And that GDP also stacks. So 7% and 4.5 on top of that, and 3 on top of that. And pretty soon our $29-30 trillion trillion economy is a $34-35 trillion economy. And there are serious issues. We have a continuing issue with China, growing issue with China. We have, this new thing with it's not new, but it's kind of growing in prevalence with cyber attacks. We have the variants, we have vaccine questions, and these are definitely risks. But there's also some really big positives, and there's one. This is other big risks. So there's some research done. It probably says it right on here, right? The Department of the Treasury and St. Louis Fed, and there's research done that said that right about 85% of debt to GDP, and the debt starts having an effect on GDP itself. And we're at 127% of GDP. That's our debt level. But as GDP grows, which we're seeing a massive number of GDP growth coming in the end of the second quarter, we anticipate that number to be large at the end of this year, and large next year, and large in 2023. So suddenly that debt, yes, we have definitely borrowed a lot, and that debt number is very large. But if we grow the GDP, then we can grow our way out. You probably heard this. We grow our way out of this debt bubble. And that's, I think, the goal. The goal is to invest in infrastructure. The goal is to invest in things that are productive. And if we invest in those productive things, then we grow our way out. John, you want something?
Well, and that's something that we've been talking about for several years now. There are a lot of people out there that think that we can handle the debt, and we can handle it even better as we continue to grow. I mean, it's doesn't seem to make sense, but and I think it's been borne out over the past several years.
Yeah, and I mean, so even though the debt number is very high, the debt service is very low, and so there's a window of time that we can grow the economy, so the percentage of debt to GDP is lower, or we can slowly reduce that debt level. You think about some of this debt is just money that the Treasury purchased, and the Fed purchased from the Treasury, right? So there's some of this debt is debt that we're printing so that we can send money to people, so that we can, it's money that we're just printing in the system, but we have to retain that as debt. So as some of the things that we're doing for the bond purchases, the $120 billion a month of bond purchases, the Fed's balance sheet, as that declines, the debt declines. As the Fed's balance sheet matures, then the debt declines. Those two things go hand in hand. So that happens just naturally over time. And if we can grow a little bit, if some of those maturities come and so the debt shrinks, and we do that while debt service is low, we have capacity to spend. We have space. It's ridiculous not to when, and you've probably read Krugman, you've probably read a bunch of people that are suggesting we have an opportunity here while the price of debt is so low, and we all did this with our homes. We have an opportunity right now while the price is so low to do this as a country. And we have a lot of stuff we could do. And we're trying to take advantage of that, getting a little pushback, as we all know. So I want to paint this a little picture with some other positive things. There are risks out there, but there's also things we never hear about. And if you think about this is Malcolm Gladwell, one of my favorite authors. I love reading his stories, him and Michael Lewis, one of the best storytellers out there. But if you think about this, if every car on the road is autonomous and they all play well together, they all stop, they're all careful, they're all, patient, they're not going to run people over, they're all working together, they communicate with each other. It means pedestrians and cyclists and little kids playing soccer in the street are safer. It means the human access around us is better. So there's a human benefit. At the same time, and I gotta check my notes to make sure I quote the right sources here. Bloomberg reports that this thing you see here is actually live, or will be live in the port in Coventry in the UK is going to have this air taxi this year, or no, next year. And then in 2023, we're going to start seeing these in the US. They are being built, urban airport for, cargo delivery and urban, taxis, faster form of transportation. At the same time, that we all know that when you receive an email and it has an attachment or it has a link that you don't know, you don't click the link, right? But did you know that there are spy pixels in emails as well? What a spy pixel allows the email sender to do is track where you go from there, see what you do with the email, see how far down the email you read, see if you click on links inside the email. And there's these tracking pixels. Now, there's actually services, there are subscriptions you can buy that actually tell you when you're about to open an email that has a tracking pixel. That's a positive. This idea of data privacy and our protection of ourselves is actually getting better. And there are companies behind these kinds of things. At the same time, there's this, and this is Time Magazine, and they're reporting that there are robots being built that are for kids that encourage reading, encourage drawing, encourage them to write notes to their aunts and uncles, encourage them to go interact with the adults in their lives. A robot will sit next to you and, Ma, you've spent 45 minutes on your device. Maybe you want to go say hi to your mom, like that kind of thing. To help kids develop social skills, to help kids develop writing skills, to help kids. How long is it before we have robots that help employees develop soft skills? When we're working I've done 25 years working in homeless services in the city of Berkeley, and one of the big challenges is a lot of the soft skills. How do you get somebody living on the street to get housing, to get regular checkup, to get job, and part of that is a lot of those soft skills. And that, so there's things out there being built by companies to do this kind of stuff. One of the big challenges we have to going to, an entire electric economy is charging stations. This is there's an Israeli company that's building this charging that will recharge your electric battery on your electric car in 5 minutes. So faster than filling your car with gas. Now imagine my wife and I, we have one diesel vehicle and one electric vehicle. So everything we do around town, we use the electric vehicle. Every time we get into it to go for a distance, we argue. She says, I don't want to wait to charge the car. I say, well, what does it matter? It's 45 minutes. We got to stop and have a snack. We wait for the car to charge. We get back on the road. And sometimes I win, sometimes she wins. Imagine that argument doesn't exist. Now there's no argument not to have an electric vehicle. Huge positive. Companies doing that as well. This is actually perhaps the most interesting thing to me. And there's just, I find these things, buildings that take from the air to heal the cracks that show up in the paint, buildings that absorb toxins from the air in the paint or in the drywall or in the actual infrastructure of the building. So there are materials companies that are working on these materials that clean the air, that scrub the air, that heal themselves. Very interesting stuff. Now, none of these are mainstream yet. None of these are going to be huge anytime soon. But if all you do is listen to the news or the nightly news, or you don't see any of this kind of stuff. You have to kind of search to find the nuggets of really interesting, positive things that are out there that are great. But I want to, before we go into these last 4 things, are there any questions about anything we've just gone over?
Question just came in about climate change and thoughts around that influencing the economy.
There's always someone who asked that question. I'm kidding. Don't give me a name.
I'm not giving you anything, even though it's not a secret.
So will climate change affect the economy? Yes. Will it affect an entire index? No. What it will do is it will say oil companies that don't reinvest in solar or other sources of energy will fail. Companies that are competing in an industry that invest in plants and equipment that rely upon oil and that kind of energy, as that gets more and more expensive because tax credits or tax costs are added to it, because it costs money to pollute, because they will fail and they will suffer relative to their competitors who are investing in electric vehicles and who are spending more upfront for buildings that are what's the platinum? There's platinum, silver, gold for architecture.
Copper?
No, there's an architectural level of clean building that the name is escaping me right now. But if you're really high end and you're spending the money on the water capture, on the waste capture, on the clean energy, on the refuse management better, if the recycling systems that are internal to the building, if you spend that money up front, it costs more to build the building, but it reduces the cost long term for the building. So I think that people that invest in what we call social responsible, what will eventually be called smart, companies that invest in these kinds of things will be more successful long term. It's sort of the Jurassic method of, companies fail because they don't keep up with technology, that they aren't competitive because of these kinds of things. And the way we invest, just to touch on the way we invest in that kind of a thing, is we own everything and we tilt towards value, small, and profitability. And for folks that we work with that have social responsible portfolios, they also have a tilt towards, they own everything, they eliminate some things, and they tilt towards more social responsible, which means we favor things that are values driven or are return driven. But we own everything because this is a long-term process. Hope that makes sense. Any other questions come in, gentlemen?
Yeah, another question came in and then it was sort of repeated, which I think is an interesting question. What do you make of the huge drop in the stock market yesterday? And then a follow-up from someone else. Yes, what about the stock market drop yesterday, although seemingly recovered today? So Jonathan, why don't you take that one?
All right, all right. So we're gonna swing for the fences on this one. Not a thing. I don't even think about it. If it's not, I actually start thinking about making changes at about a 20% decline. Um, I don't believe that anyone can predict anything in the short term. I don't think that anyone can actually explain why something happens in the short term. I think we've seen enough short-term crazy that doesn't matter. I mean, one way to think about this is a normal peak to trough decline is 15%. That's a normal annual peak to trough decline. Now, what is 15% of 35,000?
Over 5,000 points.
Yeah. So that is the Dow dropping 5,000 points. That would be normal. That would not be strange in any way. That would be an average year. So you should expect a 5,000 point Dow drop once a year, and you should treat it like, okay, okay, I breathe in, I breathe out. That's the tides. It's not a thing to be worried about or even think about. So 2% declines tend to not bother me. And to praise our client base, nobody called.
That's right.
And I did see, I'm on social media. I saw a lot of advisors say, ask the question, what do you do when your client calls and asks the question about a 2% decline? And I have to giggle. Like I have to say, you know what? You train them differently. No one should expect, you should talk about the fact what normal volatility looks like. And that's what we try to do, is talk about what normal volatility looks like. Any other questions come in?
That looks like it for now.
Okay. So just a couple things. And this is looking forward, what to think about what we just went through. We basically sandwiched 5 years of technological advancement in a 8 weeks, 2-month period of time in early 2020. There's a lot of companies that are catching up with that. There's a lot of companies that didn't move that quickly. We didn't change everything that quickly, but we changed many things, and now we're trying to think through other things technologically. Every company is in the same boat. There's a lot of changes coming. This is positive in some ways, scary in some ways, negative in some ways. But because we own everything, because of how we invest, we're not worried about how this affects individual companies. It's just interesting how it's gonna shake out. And this should be, if you think back a little bit, a year ago, we were worried about the collapse in growth. And now everyone's worried about too much growth. And if you fast forward to when growth starts slowing down again, I promise you the headline is going to be, growth is too low. It's whatever is happening is somehow tilted to be a bad thing, because bad news is good copy. And so this is just, I tend to agree with this. Over the next 12 months, stocks are going to be better than bonds. I think they're going to be better than real estate, better than most assets, but they're not going to be as good as they have been in the last 12 months. I mean, we've had a lot of client reviews in the last few weeks, and we're showing 12-month returns in 30-40% range, and that's 20-30. You can't. That's a moment in time comparing a very, very crappy March of last year, April, May of last year, to a wonderful 12-month period. So don't expect that again. It's going to be less. It's still going to be better. And going forward, it's still the best place. Equity market is still the best place to protect yourself from inflation, to participate in the upside. Again, your equities are an investment in productivity. They're an investment in innovation. They're an investment in the things that pay us long-term dividends as investors and as a culture. Very important to keep those in our portfolios. I have to put Mohamed El-Erian in here. He's a very smart guy, and every day he sees evidence of inflation not being transitory, and he has concerns that the Fed is falling behind and they may have to play catch up. And the Fed is notoriously bad at, taking the punch bowl away when they're supposed to. I just think I think that Mohamed El-Arian and there's one other guy these are the two major agitators. I think that they're not giving the power of technology, information flow, demographics, those things we talked about earlier. They're not giving them their just to do. I do think we grow our way out of this. I don't think I do think it's, though I don't like the word transitory, I do think it calms down from here. Thank you very much. Bye-bye.
See you guys. Take
Thanks,
care.
everybody.
Thanks for coming.